Good morning, it's Jeffrey Cohen. Thursday, September 1st. We're finally into September. I'm Jeffrey Cohen. I'm an investment advisor representative with U.S. Advanced Computing Infrastructures Incorporated. You may also know us as Chicago Quantum. We're an Illinois registered investment advisor, and we're here to talk today about the markets. We're talking a little bit later because what I realize is the pre-market discussions we were having an hour and 45 minutes ago had a lot less relevance to the market open. So we're hoping now things are a little more current with the market. And one of the things we talked about yesterday is that we are starting to create and paper trade and work out the kinks of a hedge fund, of a managed investment account, which if we decide to go ahead and formally introduce it, we'll open up with a custodial firm. And so it'll be all, legit on the up and up. And it'll be based on our Chicago Quantum Net Score. So we run the Chicago Quantum Net Score. Here's our model. And we take the best portfolios that have risk versus return trade-offs together. So you look at all the stocks, which ones trade better together. And those are the stocks we're looking at. And every day we rebalance, so there's a morning process. So we have to rerun the model every night, market close, to be able to rebalance every morning. And so today, as an example, there's two portfolios. There's the totally optimized portfolio, and then there's a slightly larger, slightly less optimal, but probably a lot less risk, slightly larger portfolio. And so that one changed today. And so it's very interesting to go through it and to figure out, how are you going to manage it, right? How do you keep your hedges in? Of course, it's better to have the same stocks over and over again, but the model doesn't necessarily care about that. It's not a tax efficient strategy. And so as a money manager, how do you manage it? And so we're thinking through selling it open, buying it open, and how do you go through the process? It's pretty cool. And yesterday, we had two hedging strategies we talked about for a fund. One of them was to hedge the S&P 500 just straight. So if you had $10,000 invested, you'd hedge $10,000 worth of S&P 500. The other said to look at a beta-adjusted hedging strategy. And the beta-adjusted hedging strategy actually made a profit yesterday, even though the market was down, because it basically hedged away the market fall, and the stocks picked did better than the S&P 500 fall. And so that was pretty cool, right? You can make money with a slightly different hedging strategy. So now we're into day two, and we're going to kind of work through the magic here, work through the process. And but today we're going to talk about the stock market. And let me tell you, I looked at the markets this morning. It's always hard to read on a video. Oh boy, don't do that. And I'm going to try to make it easier for you. So I'm going to blow it up. So, and I know you read faster than I talk, so let me just leave this here for you. It's a really red day today. Equity futures are lower. Right? Equity and commodity and interest rates futures are all lower this morning. It's a bloodbath out there. From foods to metals, from stocks to bonds, energy is down. So that's good news, though, for inflation. And it's actually good news for consumers. The U.S. dollar's up. The VIX is up. So the VIX is the cost of insurance. So that makes sense. Now, this is interesting because this is actually no, this is bearish. I'm sorry. This is another bearish indicator. Right? This is a bearish indicator. There's so many bearish indicators. The Nikkei, which is Japan, and China markets, including Hong Kong, were down. Europe was down. The U.S. was down yesterday. Bitcoin returned to its support level of 20,000, right? That's a big deal. That's a huge milestone for Bitcoin. Market breadth, equity market breadth. For every one advancer, there were 2 decliners. For every 24 new highs, there were 384 new lows. I'm back to my fear of missing out is a cost-effective strategy. Stocks that are down may continue to fall for a while. I'm back. I'm back to my bear market strategy, right? This, really important, okay? From a fixed income perspective, 2.6 advancers to 6.7 decliners, 40 new highs, 777 new lows. And this was largely centered in the investment grade. So we're seeing a weakening of credit quality in the top U.S. corporates. That's not helpful. So per Morningstar indices, all sectors, all areas of the market are down. And cyclicals led the markets lower. The yield curve continues to be flat, which is so interesting, right? Because that is not a good sign. It's not a recessionary sign. It's not inverted, but it's also not positively sloping. The 2-year hit a peak yield of almost 3.5%, and the 30-year is at 3.27. And what's interesting is this morning, bonds are down across maturities significantly. We're going to look at all this stuff, but I'm just going to tell you what I found, right? My 2 stocks that we own in our portfolio still look very weak. And I'm going to show you, we're starting to use more technical analysis, suggests massive quantities of selling. We're talking about we're talking about percentages of the common stock outstanding sold in the last 1 to 2 weeks. Big selling of our 2 stocks. But it doesn't mean that every stock has a lot of selling, but this is what I'm seeing, right? And I'm learning how to focus on just a couple of stocks to look for maybe messages and lessons that come out across the market. It's different than our portfolio. Our portfolio doesn't have individual biases. I'm not looking and saying, oh, I really like this stock or this sector. It's just trust the model. We've been running it 1.5 years, 2 years now, and it's not bad. Where are we in pre-market? Regional banks, even. Money managers are down. Retail, mostly down. Physical miners and metals and Bitcoin, so steel makers, gold miners, copper miners are all down. Cannabis and tobacco is mixed. Chips and semiconductors, which are your lightning rod in this market, were all down. Trucking, transport, and logistics, all down except for 2. Enterprise and personal computing and networks, a classic B2B play, down. Quantum computing mostly down. And it's interesting because a high yield stock we like looks like a great deal. And by the way, this is Blackstone. But it may go lower. There's no reason to say it won't go lower. So now let's take a look at the data. So this is what we see. So I'm sitting here and it looks like market will be down today. The question is, will it? Right? Will the smart money decide to reverse course? Or let us fall into a bear leg lower. And what I noticed was social media was silent on the markets. Politicians are silent on the markets. And so I don't see anyone coming to the rescue. Now, I do see something else, though. This is like secret sauce. In my opinion, not investment advice. I think inflation is going to read lower. And I think quantitative tightening has not yet kicked in. And so liquidity pressures are kind of in perception mode only. So I think this is important, right? I think there's some hope. If you're looking for a Fed pivot, there's some hope. But I don't know. So now that I got that all written up, right? We're gonna drop that over here. We're not gonna worry about it. Now let's take a look at the facts. Mr. Cohen, what are the facts today? Well, the first fact is, if we look at the futures, this is Yahoo Finance World Indices, not futures. If we look at just the world indices, you can see a lot of red out there, right? So you see Europe, red. Where's my mainland China? It's always important to look at. Red. Hong Kong, the Hang Seng, red. The Nikkei, red. Everybody decided Australia's red. South Korea's red. Mexico was red yesterday. So global indices are down. It is what it is, right? Futures. Let's make sure we're as current as we can be, right? Futures are lower. Bond futures, 30-year, significantly lower. 10-year, lower. So the long bonds are down 2%. It's crazy. Gold is down. Silver's down. Platinum is down. Copper is down bigly to 344. See, 350 is our number for copper. So crude is down. Gasoline, look at that. 5 cents lower today. And a lot of food's down. Okay, so that's helpful, right? That says everything's dropping. It doesn't really make sense that everything's dropping, but everything's dropping. So here's the Russell. The Russell, it actually looks like it's bouncing up and down quite a bit. It's down almost a full percent. Look at it for 5 days, and this is a rather sad Russell. Russell's small stocks. We take a look at the Nasdaq, same thing. I mean, people were so optimistic earlier, it looks like, and now just a relentless drop lower. S&P 500, relentless drop lower. Okay, that's cool. Let's look at the bonds. I love fixed income, by the way. Here's our yield curve. It's pretty flat from 1 month, actually, to 30-year. Pretty flat. And it's up to 3.5% in the middle at the 2-year. That is super interesting to us, okay? Now let's take a look at how the individual corporates are doing. So I showed you this before. Actually, I told you this before. 10,000 issues traded. A quarter down, 67% up, and the rest were unchanged. 66 unchanged. And your new highs to new lows, you're at about 19 to 1 new lows to new highs. And you can see that number is actually even more in investment grade. So corporate bonds are weakening. Corporate bonds are weakening. That's it. We know it. You look at COI-FIN over 5 days. You see it was a pretty massive drop with a lot of follow through, in this market. This is a drop, and at least what we're seeing with follow through. And what's interesting is communication stocks are up. They're the only ones that are up. And so I just find this so interesting. And the VIX is up 15%. The VIX, a lot of money, right, is being spent to insure portfolios. Pre-market. Where are we pre-market, Jeffrey? Give me another look. So we are down 130 points on the Dow fair value. We're down 21, or about 0.5%, on the S&P futures fair value. And for the Nasdaq, we're down 90 points, or about 0.75% fair value. So we're down. We're down in a pretty material way. I don't like that page. So that's not helpful. I'm going to take that out. So if we look at where the markets performed yesterday, right, where were we? And what happened yesterday? What you see is energy was down. Actually, maybe there's a better way to look at this. Let's look at the bubble chart. Okay, that's not helpful. Let's go back to the map. 1 week performance. You just see everything's down for the week. The whole market's down. I mean, maybe there's a couple stocks, Cardinal Health, Molina Health. They're just anomalous. Electronic Arts probably being acquired. Ulta Beauty. It's fine. But everything's down, right, for the week. I'm just going to keep rolling here. Jobless claims down. Layoffs are low. That's actually good news. That's really good news. People are working. Okay. That's interesting that the stock market is crashing while there's really good news. That's got to be Department of Labor unemployment claims. DOL. Unemployment. Oh, it's Bureau of Labor Statistics. That's it. Well, that's the real reason. Holy crap, is that bad news? All right, we're going to come back to that. That's actually worth talking about. I'm sorry. It's so funny. You look at the headline and you're like, oh, jobless claims fell. But it's a different story. I see a different story there. And so gasoline at 238, 239, that's really low. The bonds are just dropping. They're testing the lows in June. It's fast too, really fast. Bitcoin, we talked about it, down to 20,000. Looks like the U.S. dollar broke through the euro dollar again. Continuing jobless claims. All right, let's just keep rolling here. I don't want to look at that one. We can look at mortgage-backed securities real quick. Significantly lower. Moderately lower. This is the 4.5% uniform mortgage-backed security. The 5% uniform mortgage-backed security. The Ginnie Mae 4.5 and 5 are all down. They're all weaker. So mortgage-backed securities are down. You can see right here the average mortgage rate is 5% for a 30-year fixed. Okay. We'll take a look at 1-month treasuries. 2.11. We'll look at the 1 year at 3.5. God, that's high. Remember I talked about it earlier this morning at 3.45? So 3.35, 3.4, 3.45 for the 1 year means you have an elevation of the yield curve Look at the 10-year Treasury at 3.25, and look at the 30-year between 3.25 and 3.5 at 3.36. Just so interesting. We do not have new data from Fred on total assets. Consumer Price Index, no new data. And that's it. So I'm just going to go back to the simple chart that I have here, right? The futures chart. And so right now, the markets are set to open lower. Global equity markets were lower. Fixed income, right? Yields are up. Stocks are down. Dollars up. Economically sensitive metals are down. So it's just a bloodbath today. And so then the question is, what should you do? Right? If the markets are falling, what do? You probably don't start your own hedge fund, right? What do? Well, let's talk about it. What do? And so maybe this is for individual investors. It's a different answer than for money managers, right? So what do you do when the markets flash red for equities and fixed income and economically sensitive metals and commodities? When the US dollar is stronger than ever. So what do, right? And so I'll tell you what you should do is something that we got out of our shorts too fast. So you should be a balance of long and short. You should not buy any new stocks until the pain subsides. Let the market run lower. And I have a term for that, which is fear of missing out is a low-cost strategy in a bear market. Time to buy tomorrow. What else? I'm not sure. I say step back, right? Now for us, for what I'll call money managers, institutionals, and high net worth individuals, right? There is significant movement in the markets. So look for your edge. We have an edge somewhere, and we don't talk about it, but just look for your edges, right? And trade them, and know that there is enough movement to profit. And so that's where I leave you. I want to thank you for listening. If you liked the video, I mean, we're not paid to make them. We make them for you. We make them for ourselves as well. Hit the subscribe button. Let some people know you like it. Spread the word. What that does for us is that YouTube will share the videos with people. You know, on the right-hand side where it says recommended for you to watch next, it says, oh, this is pretty good stuff, right? Go ahead and watch it. And you can drop a comment. That's great as well. And if you really want to learn more about us or become a client, especially we got this new paper-traded fund that we're building, right, based on our model, come to our website. It's chicagoquantum.com. The most important thing, according to FINRA and the SEC, is I point out we have a brochure. I have a summary brochure and I have a full brochure. The full brochure gives you all of the terms and conditions and costs of investing and all the prices and what you get and all that good stuff. That you have to read before you buy. And then you can buy a run. You could buy an up run. You could say, all right, what am I getting? And then we actually added a video how you might even use that up run, right? And we post a lot of research, negative beta stocks, high dividend stocks. I got a price variance thing I'm doing. We talked about liquidity. We used to have a lot more data, but we pulled it out because I realized people weren't really looking at it. And the the cost of time to build it, but tons of information about stocks that we produce in our model every single day. And we look at every single stock that traded in the United States every day. And we pull them out, we separate them into ups and downs, and then we do our analysis. And you can have all that. It's great. You got to know what to do with it. You have capital to invest. And so, all right. I just wanted to share that with you. And thank you so much again. Thank you for watching, and good luck in the markets today. Be safe out there. Bye-bye.